Well, good morning, everybody. Morning. We are going to get started, but as always, if you want more to eat or drink, you're not going to bother me if you get up and go grab some stuff. Make yourself at home. We can be fairly informal this morning. I think I have met most of you in the room. I'm excited every time I come down here. More faces are familiar. But if I haven't met you, my name is Jamie French. I am Jim's business partner, co-owner of Advent Partners. And I want to start by just saying thank you. Thank you for taking the time to come in and hear what we have to say as it relates to the markets. But more importantly, thank you for choosing to place your trust and confidence in us. We know you have choices as to who you work with, and there's a lot of people out there that you could choose to work with. And we appreciate and value the trust you place in us. We work very hard to make sure that that trust is not misplaced, and we appreciate you. So I wanted to start with that this morning. I'm very excited to be down here with you this morning, but I will admit I'm also a little anxious. Jim Dunlop, as I believe you all know Jim, and you see him in the back of the room. He was planning to present this today, and he has lost his voice. And so I'm pinch hitting this morning with a little less preparation than I normally like. But hopefully we'll muddle through it, and I appreciate your grace with me this morning as I go through this. We did talk for a little bit. I did ask Jim, I told him I was going to poke a little fun at him about losing his voice this morning and having me do this. But we did talk a little bit. I asked him if he had any miming experience. Maybe he could just get through the presentation. But his miming experience was very limited. On a side note, if you want to hear a story after the session, I actually do have a little bit of miming experience, and if you want to hear about that, you can ask me about that. It's not what you think, though. The material we go through today, it's going to look familiar. You know, when we do these quarterly things, we pull a lot of information from JP Morgan. And so a lot of the charts you'll see, they probably look familiar, but the story can change each time depending on what's going on in the markets. And we have, I think we have the option of about 150 or so different slides to choose from. I'm only going to go through about 149 of them. So, you know, don't worry about that. No, it will be hopefully fairly short and sweet. And the last thing I'll mention before I get started, if anyone else, if it's always been your dream to present some information like this in front of a crowd, you're welcome to come up and do the presentation. If anyone else wants to do it, this is your last opportunity. Okay, so we're going to start, and hopefully I can make sure. There we go. We're going to start with a chart that probably looks familiar to you. Basically, it's just looking at the trends of the S&P 500. And there's a lot of different indexes we can track out there. We generally tend to use the S&P 500 because it's a broad measure of the larger stock market. It's a pretty well-known measure of that. And what you're looking here, just history all the way back to 1996, sort of the peaks and troughs of the market. And when we're looking at this chart and the next, what we're really focusing on is the PE ratio, or the price to earnings ratio. So you can see kind of at different inflection points. If you look over here in March of 2000, when the market had a peak, the PE ratio was 25.2. It was 15.1 at this peak, 19.2 here, 21.4 here, and then currently sitting right around 19.8. And why do we use the price earnings ratio? Well, in essence, if you think about any stock or any series of stocks, obviously you care about the share price, right? That's what actually shows up in terms of the value of your portfolio. But how does that share price reflect how the company's actually doing? If you think back in the late 90s and what we refer to as the tech bubble, right? Share prices were really high, even though companies maybe were hemorrhaging money, right? It was the dot-com area. If it was a tech company, investors wanted in. whether that company was making money or not. And so it's important to kind of look at the PE ratio over time. And you could also see, you know, what it looks like at the troughs in the market. So the next slide here. Did it go? There it goes. I just got to be patient. So this is a really interesting slide to see, okay, where do we sit today? And again, you've seen this chart, but it changes every time. So if you look at this middle line here, that's the 30-year average for the PE ratio, and that's at about 16.6. And if we look down here, this represents a PE ratio of about 13.3. It's one standard deviation below, one standard deviation above is 19.84. And as you can see here, we're at a pretty high valuation in terms of historical averages. We're right about at that one standard deviation. If you think about it, you know, over the last 2 years, if you think about the stock market, it's basically been a wash, right? 2022 was miserable, 2023 was great, right? And so it's basically been a wash over the last 2 years. But prior to that, we had 3 really strong years. So we've had 4 out of the last 5 years have been really strong years in the market, despite, you know, if you go back 4 or 5 years, what was going on then? 2020. And so despite all of that, we've had some really good years in the market. And so the market is, you know, fairly highly valued right now. Does that mean it's set for a correction? Does that mean 2024 is just going to be a, you know, an abysmal year in the market? Obviously, we don't know that, but it is something that we're cautious about. And I would say, you know, it's not our job to prognosticate, but, you know, I don't know that I'm super optimistic about big, high, you know, double-digit returns in the market this year. But if earnings come in strong, then that can, you know, if strong earnings come in, then that brings the earnings up and the ratio down, and, you know, maybe there is room for additional growth. So a lot of it depends on the earnings that we see in the market. In fact, earlier this year, at the very beginning of 2024, I don't know if you remember this, but like the first week, we had one of the worst starts to the year ever. It was short-lived, and then we had some earnings come in that looked fairly positive, and the market kind of bounced back. And so earnings is going to be something that the market's going to be sensitive to this year. And if you weren't aware, it's also an election year. And in election years, there tends to be a lot of volatility and a lot of noise. And so one thing that you might hear from the various advisors on the team over the course of this year is maybe not listen to the noise, stick to your disciplined strategy, and recognize that what's going on in the political world doesn't drive a whole lot of the investment decisions that we're making. It drives a lot of short-term volatility, drives a lot of angst in the American consumer, the American investor. But sometimes it's healthier just to kind of tune out the noise. So that's a look at the valuations in the market. Interestingly, underscoring the importance of a good diversified portfolio, and I don't have a chart for this, but international valuations are actually quite a bit more attractive right now relative to US valuations. And so again, you've heard us preach over time the importance of diversification. And, you know, if you're in one of our investment portfolios, you probably have a certain allocation to international investments. And that's important when we're looking at, you know, things like this and saying, hey, there is the opportunity. We could be fairly highly valued at this point in time. Okay. I failed to mention this at the beginning, but if you have questions as we go, please shout them out. If they're easy questions, I'll answer them. If they're difficult, I'll probably defer to Jeremy in the back. He's pretty smart, or Chris up front. I'll let them handle the tough ones. So buckle up, guys. All right, so let's take a look at value versus growth. So when we're investing in the stock market, we pick certain types of funds, and in particular in the stock-based funds, we look at value-based funds and growth-based funds. You might even from time to time, if you looked at the names of your funds, you might see a value or a growth, and that's what it's referring to. Basically, without going into a lot of detail, it just represents the objective of the fund and what the fund manager is looking for. And so oftentimes, for example, a value fund is going to invest in stocks that pay higher dividends typically. And you'll see an example of that here. Why do we look at this? Well, value and growth tend to function a little bit differently depending on what's going on in the market. And so if you look here, this, remember I mentioned earlier that the kind of the tech bubble. And so during that time, value was pretty cheap, growth was pretty expensive, right? And the reason growth was expensive is because it had done so well leading up to that. And so we can look at value stocks versus growth stocks, or value funds versus growth funds. And if you look at the forward PE ratio, growth has done really well, but its current PE ratio is 26.7. If I go back to that prior chart, the overall market is like 19 something, right? And so growth stocks have performed really well for a long period of time, and as such, their PE ratio is a little bit higher, value stocks a little bit lower, more, actually a little bit below the long-term average. So that's just a look at, and you can see also the dividend yield. Value stocks, both current and long-term averages, are quite a bit higher because they're more focused on dividend-paying stocks. And again, if you have a portfolio here, I'm just telling you things that you are already invested in and how we, some of the information that drives the adjustments that we make. But you can also see here on the right, this chart is basically looking at how does the performance of growth compare to value in different interest rate environments. So if you look at the first couple columns, in low interest rate environments, 0 to 2, 2 to 3%, growth tends to outpace value. We've been in a low interest rate environment for quite a while until, recently, right? But what happened over the last couple of years? The Fed, in an effort to keep inflation down, has aggressively ramped up interest rates, which has heavily impacted the bond market. We'll talk about that in a minute. But also has affected, value and growth. And so growth typically outpaces value at lower interest rate environments, but in higher interest rate environments, you can see here it kind of levels out and here it kind of flips, right? So the higher the interest rates, typically, that's where we see value outperform growth. And so we're in a period of time where, again, if you just look at the stock market in general, it's done very well. Valuations are high. But there are opportunities, like maybe we invest a little more in value versus growth. Maybe we invest a little more in international, where the valuations are more attractive.
When you look at the difference, though, between value and growth, growth seems to greatly outdo the value, whereas when it does flip, it's not by very much.
You're absolutely right.
It kind of indicates to me that it would be better to be in growth than value.
Yeah, and we have a chart coming up in a couple slides that will show you, some historical information as it relates to those two. But yeah, I mean, and frankly speaking, for quite a while, growth has outpaced value. Yeah, this is I was looking to see what the period of time was, 1979 to present. So it is a good sample size there. No, good point. Okay. So the next thing I want to talk about is, we hear a lot about how is the S&P 500 doing, and I wanted to highlight an interesting, I don't want to say it's a change, but it's something we have to be more aware of when we look at the stock market. If you just listen to the radio or gosh, I almost said looked at the newspaper. How many people still get the newspaper? There you go. Good. But you hear the Dow and the S&P, right? The Dow is 30 large U.S. company stocks. The S&P is kind of a broader measure because it's 500 different stocks. So we often use that. But the S&P, I've heard some people joke, it's become the S&P 10 because it's heavily weighted towards a certain number of, a small number of very large companies. And this is just kind of looking at some of that information as it relates to the S&P 500. So if you look over here, if we look at just the top 10 stocks, which is represented by this green line in the chart here, just the top 10 stocks in the S&P 500, Their current PE ratio is at 29. So again, even higher above that valuation that we talked about. The rest of it is at 18.3, which is, it's still above the long-term average, but not quite as high. And you can see, well, you can see the 19.8 right there. You can also see that 86% of the return has come from those top 10 stocks. Interesting, right? So you got to be careful not to just, I'll just invest in an S&P 500 because it's not necessarily as diversified as it once was, because it has become more concentrated. You can also see here, in terms of the weight of those top 10 stocks in the S&P 500, basically they represent 32.5%. So if you think about, okay, 10 stocks out of 500, well, that's, 10 500ths. But actually, in terms of weighting, it represents 32% of that number. Okay, so is that a bad thing? Not necessarily. It's something to be aware of. It's something to manage, as you would in any other investment decision that you're making. One of the things that we look at is, but how does that correlate to the earnings that those companies are generating? If it's 32.5% of the weight, but it's only generating, 3% of the earnings, that's, obviously something that maybe we'd want to look somewhere else. You can see, those top 10 stocks, it doesn't align perfectly, but they do represent about 21% of the earnings in the S&P 500 too. So this is just an interesting chart to give you some awareness. Like when you hear, here's what the S&P 500 is doing, or even when, in the investment world, I think sometimes we're guilty of, trying to compare, well, how did the manager do compared to the benchmark? Well, depending on how you're invested, might not be a good benchmark to compare to unless you're invested in a very tech-heavy portfolio, which probably isn't the best, diversification. Okay, so just an interesting chart on the makeup of the S&P 500. So Bill was my plant in the audience asking the question about growth versus value.
Second question.
Yeah.
When you look at that chart on the left, why aren't we investing all of everything in the top 10 instead of a more broad thing? Because it earns more. I don't know.
Yeah. So the first thing I would say is we don't want to buy high. So if now we say, oh, let's invest, it's done really well. That's an easy, I don't want to say an error, but it's a cautionary mechanism, because you always want to look at, well, how did this investment perform? But if all you ever do is buy the things that perform the best, and all you're ever doing is buying high. And so there's always this balance of, even as investment professionals, when we're talking to clients, it's like, well, this fund has done really well. Why don't you invest in that? Well, because it's done really well.
That's only a year short. So.
Yeah. Yep. Okay, so good question again. And
But also add that those 10 stocks were the biggest losers in 2022.
That's true. Yes, if you looked at the S&P 500 compared to the Dow in 2022, it was a much steeper drop. Thank you, Jim. And your voice sounds great, by the way. Podium is still open if you want it. Okay, so this is a busy chart. I know you've seen it before. I'm going to just read all the numbers to you. No, I'm not going to do that. But to Bill's point, like if we look historically at growth versus value, and again, this chart here is, we have the 10-year and then the year to date. And basically, just as a reminder, we often look at what we call these style boxes, which is looking at stocks relative to the size of the company, large, mid, and small. And then is it, as I discussed before, oh, my laser might be dying. Is it value? Is it growth? Or is it kind of a blend of the two? And so if you look at those numbers, year to date, obviously it's a little early in the year, so we don't have to place a lot of stock in those numbers. But over the last 10 years, to Bill's point, growth looks pretty good, right? Across the board, particularly in the larger companies. In the smaller companies, it's probably a little more even. And then if we look, even whether we're looking at since the last market peak or since the last market low in February and March of 2020, again, growth looks really good, other than in the small cap area. And so again, historically, over the last several years, growth has done really well. And if you think about it, even if you go back a little further, with the exception of 2022, the market's done pretty well since 2008. Right? I mean, a couple years of exceptions in there, but it's actually done really well. And growth stocks have been strong performers during that time. So that's just kind of looking at, how value and growth and small and large compare. Also coming back to that PE ratio I talked about before, this is expressing some of the same information, but on a percentage basis. So if you look at growth stocks, they're at 141% of their 20-year average, whereas value stocks are still above, but not quite as high. Yeah.
Jamie, are the 10 top stocks of the S&P 500 all considered growth? I know they're large
I
companies.
don't know that off the top of my head. I think it's a mix of them.
But ExxonMobil would be classic value stock.
And they're in the top 10?
Yes, at the moment.
Thank you.
Okay, so this is a chart I know you've seen. I use this a lot. Like in just about every meeting I talk about with clients, I use the next two charts because especially when the markets aren't going well, it's important to remind ourselves of how the market works. When the markets are going really well, it's also important to remind it doesn't always work this way, right? And so this is in essence looking at the history of the S&P 500 back to 1980. The gray bars represent the returns each year. The red represents the volatility within each year. What's the largest drop that occurs within that calendar year? And the headline here, I always like to highlight the headline. The average drop in the market in any given year is 14%. Right? So if the market's dropping by 14%, that doesn't feel so good, but it's just an average year. Within the year. But on this chart, 33 out of 44 years are positive. And so I look at, there's a couple of areas that I like to highlight as I think about, what has the market done? Where is it now? So we talked earlier about the tech bubble. How many of you enjoyed those 5 years in terms of market returns, right? Every year for 5 straight years, north of 20%, a couple of years north of 30. And the challenge with that is that tech bubble eventually burst and you had the only period on the chart where there were multiple negative years in a row. Okay, so that was the 2000 to 2002 recession. Can everyone pick out 2008 on the chart? That's not difficult to pick out. But look at what we had from 2008 up until, again, 2022. 2023 was a really nice recovery. And then year to date, we're up a little bit. Again, it's very early this year, so no conclusions to be drawn from that to this point. Okay. But again, just a good reminder. And again, when I look at these 5 years, it's not quite those, right? But 4 of the last 5 years have been pretty strong. And so, I'm going to be paying close attention to earnings. Are the earnings there to support the share prices? And if not, then we're probably going to experience some volatility. And as I said before, in an election year, it's going to be volatile. It just always tends to be very volatile in an election. The pain that we all felt in 2022, which was somewhat alleviated, but not fully alleviated last year, was that not only was the stock market doing this, but how many remember what the bond market was like in 2022? Right? Historically bad. The bond market is usually our friend. It's fairly steady. It doesn't make super high returns, but it's much less volatile. Like when you look at these red numbers, they're all over the place, right? Those are the waves that we ride in order to get the returns that we want to get based on the gray bars. The bond market is a little more consistent. And if we look at history of the bond market, so much more comfortable of a ride, right? Look at those red numbers. It's very low. Generally, almost 3 or 4 years where they actually lost money. And when they lost money, it was like 1, 2, 3% at worst. Like, oh, remember the mid-90s when we lost 3% in the bond market? Oh, that was horrible. But then let's look at last, or 2022. I'm still getting used to saying not last year. 2022, double-digit returns. Does everybody know why? What was the Fed doing? Jacking up interest rates, keep inflation down, jack the interest rates up. Bond prices don't like rising interest rates. Why is that? Well, think of it this way. If I buy a bond for $100 and it's paying me 4%, and then interest rates go up and you can buy a bond that's paying 6%, how much is my bond worth? It's not worth $100 anymore. Nobody's going to buy my 4% bond when they can get for the same price, they can get a 6% bond. So as interest rates go up, bond prices come down. This was one of the most aggressive interest rate hiking periods in history. And so we had an unprecedented, I would say beyond unprecedented, like if we had lost 6%, that would have been unprecedented. But we lost 13%. And last year we recovered some, but not all. And we're, that's still an area where there's room for recovery. And quite frankly, if my memory serves correct, a lot of this growth came towards the end of the year when the Fed, A, stopped raising interest rates, and then B, indicated that, hey, we think in 2024, we're going to start to actually reduce rates. And then they came back a few weeks ago and we're not really sure what they're doing now. So, but that's the Fed. So just a good lesson in history of, in fact, I would say if earnings don't come in strong on the stock market this year, and if interest rates actually do start cutting, and we see bond prices, we might see more returns out of our bond funds this year than our stock funds. That's not a prognostication. It's just, I'm just sharing kind of the logic of how the market works and what we're paying attention to. Any questions on any of that? Okay, so next we're going to look more into that's kind of a look at the markets, but we also, this is an economic update. So we want to talk about some of the economics behind it, what's going on in the US and internationally. So this is just a quick look at economic growth and the composition of GDP. I know you can read the title as well as I can, but you can see historically this blue trend line. And you can see here back in 2020, that steep drop in GDP. We all know why. We see the recovery, and now we're kind of back near that trend line. And this kind of shows you by quarter how that's done. The main message from this screen is the largest driver of GDP when you look over here is consumer spending. And so what affects consumer spending? Well, employment affects consumer spending. Inflation affects consumer spending, and interest rates. Because unfortunately, as Americans, a lot of the spending we do is on credit cards. and so interest rates, if interest rates are higher, then spending comes down. Also, a large part of consumption is what we spend on housing. And so if interest rates are high, our housing costs go up and energy prices can go up, et cetera, et cetera. So this is just kind of a look at GDP and how that's impacted over time. It's also kind of a look at, the closer, the more in alignment or the higher we are, like if we're above that line, like we were back here, then, there might be an increased risk of recession. So speaking of, this chart is going to be familiar to you, but we often look at, okay, so what is the risk of a recession? We've had 4 out of 5 really strong years in the market. We've had these interest rates going up like crazy, not sure what the Fed's going to do this year. What is the risk of recession? We hear about it all the time. And so we often look at these 6 factors that are determined by the National Bureau of Economic Research that are indicators of recession. And so, in essence, what we're looking at, green represents the, growth. So in these factors, month over month, that number is better than it was the prior month. Red represents a downturn, and there's various shading depending on, how strong that growth was. So what you're looking at up top here is a month over month look at it. Each month, what is that looking like? And so again, not too bad, but we are starting, you see here in household survey employment, that's, month over month, that's starting to come down. But if we look at the same information over the last 6 months, so this is month to month, this is the last 6 months. And so that household survey on employment is still positive over the last 6 months, but month to month, it's starting to decline. And so that's an area that we're paying attention to. But largely still not a lot of red flags here, but, you know, and in essence, you know, you are seeing, okay, that's went from green to yellow. This is moving orange. So there are some things that we're paying attention to, but over the last 6 months, you can see some of these are still pretty strong. So again, I'm not an economist. I'm not here to say when the next recession will be, but these are the factors that you know, in essence, define a recession and what we're paying attention to. And the two that are kind of the two that we're paying closest attention to would be industrial production and household survey employment. All right, I'm not going to spend as much time on this next one, but this is just kind of taking a look at our federal finances. You know, what does the national debt look like? What does the federal budget look like, or the federal budget deficit, I should say, which we've become accustomed to. But as we look at this, and as they sort of over here, you can see there's actual numbers and then what's forecasted. You can see the forecast is that net national debt is going to continue to grow. I thought it was interesting to look at the underlying assumptions, though, because we often look at like, what are the long-term averages? What do we expect those to be? And so this is showing, okay, over the long term, this is going in and out. Over the long term, real GDP growth there at the bottom. They're anticipating, you know, 1.9% from 28 to 33. Anybody else know what's going to happen in 28 to 33 yet? Those are just forecasts. The 10-year treasury, you know, 4% in 2023, that looks largely unchanged. Headline inflation, obviously they're anticipating that's going to come down, and you've probably often heard the Fed say, hey, our target is to get that down closer to 2%. And then unemployment at 4.1% at the end of 23 and expected to remain thereabouts or around 4.5%. So if you're ever wondering like, oh, what should what should inflation be? What should unemployment be? This is what they're forecasting as kind of the long-term numbers. So that's our federal finance. I don't like to spend a lot of time on our federal finances because they never look very good. If I translated that to my personal budget, I wouldn't feel very good about that. But we also look at the personal side of things. And so here's consumer finances. And in essence, the message on this chart is we're starting to see some of the implications of the higher interest rates and what that's doing to consumer spending. So the chart on the left is in essence looking at what makes up consumer spending. And so you see, you know, homes obviously is a big part of that. Interest rates, that particular area is very sensitive to interest rates. But down here is what's interesting is, you know, what does the household debt service ratio look like? And where are we starting to see delinquencies, right? Delinquencies, late payments on debt, that's a good sign that, you know, people are starting to feel the pinch, right? And if they're starting to feel the pinch, they're not going to spend in other areas, and that's going to affect consumer spending, which is a big part of GDP and affects earnings of the companies, et cetera, et cetera. So you're starting to see over here an uptick over the last couple of years in delinquencies, particularly in auto and credit card. And you can see as a percent, if we look at debt payments as a percentage of disposable income, you know, they peaked in the fourth quarter of 2007, you know, at 13.3%. So we're not there. That's good. But it is creeping up. If you look here, this trend here, it's creeping up and it's currently 9.9%. So again, those are the things that are affecting consumer spending, which affects share prices and profitabilities of companies. Okay. Also, you know, why is another point related to this? Why is often the fourth quarter a strong quarter in the market? You know, some people talk about the Christmas rally, right? People are out spending money, getting ready for Christmas, and so, you know, that's creating some profitability for companies, and the stock market responds accordingly. So we don't know.
On the bottom right there, student loans. We heard so much about student loan debt, but why is it sudden decrease, substantial decrease there?
Yeah,
Because the government
I think
allowed everybody to defer those loans since the pandemic. So nobody was defaulting because nobody was paying.
Oh, it was default.
yeah. Did anyone else say deferring, or was that Jim that I heard first? Oh, I was so impressed. I was like, wow, somebody's got a good answer to that. And it was Jim, of course. He's pretty smart about some of this stuff. Okay. So that's consumer finances. The other thing we look at, what does consumer confidence look like compared to the stock market? So there are measures, obviously, that we look at from time to time to see, you know, how confident is the consumer. The message from this chart, it's very interesting to compare this to the S&P 500 valuation. It's kind of a good study in human behavior and a good reminder why we don't just follow our gut when it comes to the markets, right? If we followed our gut, how many in March of 2020, when we were all getting sent home from work, would have been like, it's time to buy? How many would have said that, right? How many would have anticipated that we'd have such a strong market for 2 years at the beginning of the COVID pandemic? Nobody would have thought that. So this is something that is interesting. In some respects, I would say if you wanted to be a contrarian, that might be a better approach, is like, hey, if consumer confidence is high, that's probably a time to sell. And if it's low, it's probably time to buy, right? Like go against the flow, because our natural, the average investor is probably a more emotional investor and maybe is violating some of those basic principles of investing. But you can see here, in June of 22, that measure was at 17.6. Oh, I'm sorry. Yeah. Here we are in January of 24. So you can see the increase in consumer confidence, which obviously tends to trail how the market's doing, right? And so the market does really well. People get more confident and think, okay, now I'm comfortable, I'm ready to buy. And then they end up buying high. And so it's just interesting to look at how this relates to the valuations in the market. It's, in my mind, probably better to look at, you know, what's the valuation of the market and what's that going to do. But the reality is it's kind of an inverse relationship, right? When valuations are high, our consumer confidence goes up, right? But really, that's the time we should be being more cautious. What does anybody know what Warren Buffett used to say, his famous quote? When people, I'm going to try to not butcher this. When people get fearful, I get greedy. When people get greedy, I get fearful, I think is the quote. All right. So if you take nothing away, Warren Buffett's done okay, you know. So if you take nothing away, that's something to remember. Okay, I mentioned earlier, like, what does unemployment look like? Again, we're at historically, we had really high unemployment in the middle of the pandemic. That came drastically down. And you can see here in December of 23, this is looking at unemployment and wage growth. The 50-year average is 6.2. In December, we were at 3.7. Wage growth, we're actually a little higher than the average, but pretty close. The labor market is slowing. That's what this chart would show us, but there's still a large backlog of job vacancies. And so that should limit any significant rises in unemployment. And I would also say that wage growth will probably moderate as well. I mean, we are a little bit above our historical averages. And, you know, if corporate profits decline, then that's probably going to slow wage growth. So that's a quick look at unemployment and wages. And then again, we've already referenced inflation a little bit. You can see, again, trending downward. We're here below the trend line here. We're looking at here, if you look at the 50-year average, headline CPI, core CPI, which is basically inflation without food and energy. And you can see the different factors that make that up. So the Fed, obviously, this is what they're paying close attention to. I'm actually going to talk about the Fed shortly. My next slide. Good segue. So this is obviously what the Fed is looking at in terms of making their decisions. So what do we expect them to do? This is in essence, looking at their projection of what's going to happen with interest rates. So remember, I said the aggressive interest rate hikes that we saw all the way up to the federal funds rate at 5.38%. And you can see the expectation that those are going to come down over the long term. In my estimation, the bond market probably won't recover what we lost in 23 until we start to see that drop and drop more consistently. So again, just a reminder to stay diversified and make sure, you know, you have an appropriate exposure to both stocks and bonds in the portfolio. And we'll talk a little bit later, I think, about even just the different duration and bond markets. Yes.
That's obviously pretty volatile with what they're showing. I can't see it very well. What is it, 93 today? That's true. Okay, 93 today. What
Oh, I'm
is-
sorry, yeah.
What is normal? Because I've been astounded with everybody that's unbelievably low, well, it was when we were near zero, unbelievably high at 5% and 6% Fed rate. Now I realize that the retail rate would be higher, but my parents were elated that they got the last 6% interest on a mortgage in 1967. We paid 12.5%
Yep.
in 1980.
Yeah.
What is normal? Or is all the chart back 50 years gonna look like that?
Yeah, so I would say, you know, long term, what they're projecting is, you know, it's going to drop down to around 2.5%. I would say, how do you define normal, right? Like,
Well,
I don't think,
historically, what has it been, or
Yeah.
has it always been this volatile?
yeah, so I don't think we're ever going to go back to the, 12, 15% interest rates. I think we're always going to be around with that.
Hold you to that.
Well, I mean, and it's good and bad, right? Like the conservative investors over the last several years, it's been frustrating, right? And they're elated to be able to say, oh, I can invest in a CD now and or in a bank account and actually get 4 to 5%. Even in our conversations a couple years ago, you know, people would say, hey, should I do something with my savings or money market account, or should I look at a CD? And this was probably more bluntly than I stated at the time, but it was the message was kind of like, it doesn't matter. Like, do you want 0.01 or 0.05? You know, now that has swung the other way. And so for conservative investors, the positive side of that is what they're getting. The negative is obviously, you know, what do those mortgage rates look like? So I don't have an answer to what's normal other than I would say the 12 to 15% years weren't normal. And I don't see those happening going forward. I would say where I would see it is between 2.5% and 4%, but I'm not an economist. Like don't take my word for it. That's not my expertise. Happy to hear from other members of the team who would want to feel that one if they want. What's normal? Jeremy's back there like, there is no normal, Jamie.
Good up there, team.
Thank you.
I would just say that the 0% interest rates that we've seen on and off in the last 15 years are not normal.
That's true.
Yeah. So, but I think where we're at now, if we look at a 50-year place, we'd all say this is a pretty normal place where we are today. But if
Yeah.
you look at it in the context of the last 20 to 30 years, we're pretty high.
Yeah. Yeah. I'm gonna check on time. All right, I'm gonna keep moving because I don't want to. So this is similarly just looking at the history of interest rates and inflation. So this kind of answers your question. You know, real yields from 58 to present is average around 2%, but that's been a lot of, you know, high interest rate periods and low interest rate periods combined. So there's the period that you were just talking about, which we haven't seen in quite a while, probably long. And this is in essence just looking at, okay, if I'm making 3% on my money, that's great. But if inflation is 3.5%, then I'm not really getting a real rate of return. I'm actually losing money. So you can see currently inflation at 3.9, nominal yields at 3.99. So we're at least getting a real rate of return at the interest rates as they are today. This is a busy chart, but basically, I talked earlier about how interest rates impact the bond market. This is just looking at it by different sectors of the bond market. So over here, what you're looking at is the various different types of bonds and how much would a 1% change in interest rate impact the value of that particular type of bond fund. So you can see the longer the duration, like a 30-year treasury which is right here, this line here is going to be most sensitive to interest rates. right? A 1% rise, or excuse me, a 1% fall in interest rates, you know, would bode well for long-term treasuries, but a 1% drop would obviously have more impact than, say, some shorter duration things. So in a period where interest rates are changing dramatically, we're always sensitive to what the duration of our bond portfolio is, because we don't want, you know, our bond portfolio to be too susceptible to those changing interest rates. Try to moderate that a little bit. So this is just looking at the different types of bond funds out there. Okay, yield curve. You've seen this before. I'm not going to spend a lot of time on this because it hasn't changed a whole lot. You can see, you know, from December of 22 to January of 24, not a whole lot of change, but we're still far from where we were back in 2021. And this is just looking at how do interest rates change based on whether it's short-term or long-term. So we're still in an inverted yield curve, which some would say is a predictor of a future recession, but we never know how long that recession is. And we've said this before, but I'll say it again. Every recession has been preceded by an inverted yield curve like this. And that's why people say, oh, well, that's a signal of a recession. However, not every inverted yield curve has been followed by a recession. And even when it has, the time between when the yield curve inverted and when the recession actually occurred is sort of indeterminate. It can be shorter, it can be even multiple years. So it's not really a great predictor, but it is something to watch. So this is showing the same portfolio returns for a hypothetical portfolio of 60% stocks and 40% bonds. So the chart is going to look very similar. Again, in 2022, a 16% loss, in 2023, an 18% gain, because the stock market did really well, but the bonds didn't do as well. The important message here, you know, why do we diversify? If you look at the 60-40 portfolio, which on this chart is the gray bars, we're looking at 1-year returns, 5-year, 10-year, 20-year. Whether you look at a 5-year rolling period, a 10-year rolling period, or a 20-year, you never see the 60-40 be negative. Okay. Generally speaking, even if I said, okay, if you just invested in 100% stock portfolio, which is that kind of limeish green, I don't know what you call that color. You know, generally speaking, if you look over any 5, 10, or 20-year period, you don't lose money. And if you do, you lose very little. But there have been periods where over a 5 or even 10-year period, the stock market has actually lost money. That has not happened with a diversified 60-40 portfolio. This is not a recommendation that everyone goes out and invests in a 60-40 portfolio. That's not what I'm saying. But it just gives you a little bit of history. So this is from 1950 to 2023, average return 11.2%. Average return of a 60-40 is 9.3 with a lot less volatility. Okay. You've seen that before. You know that if you're invested with us, it's why your portfolio looks the way that it does. So it probably doesn't surprise you. So I talked earlier about CD rates. This is in essence just looking at what did from the peak of the interest rates, what did the next 12 months look like in total returns? What is the message of this? Well, what this is meant to convey is that once interest rates have risen, and I can tell you, you know, we're having these conversations with clients too, like, hey, if you have some safe money, make sure you're looking at your interest rate, make sure you're going out and taking advantage of the money markets or CDs that are out there so that you're getting a better interest rate on your money. But there is an opportunity cost to that, because if you look at historically, the 12 months following the peak of those CD rates, the bond market, as represented by the Bloomberg US Aggregate, the S&P 500, the 60 portfolio, if you look at the next 12 months of returns, they always look, and this is looking at several different periods of high interest rates or peak interest rates. You can see that the 12-month returns on other asset classes have actually been really good. So when interest rates go up, we're like, oh, we should take advantage of the high interest rates. But we also need to remember, you know, the subsequent 12 months returns historically and all these other asset classes have generally tended to do well too. Okay. Everybody follow that? Okay. All right. This is, I'm not going to spend a lot of time on this, but this is in essence looking at, what happens at the end of a Fed rate hike cycle. Similar message, like over the next, the performance, I think this is 12 months before and then 24 months after, what happens with various asset classes. And again, similar message to the last slide. All right, so what about government and the stock market? What about elections? How is that going to impact things? So I like this chart because in essence, it's looking at GDP and then the S&P 500. It's looking at it by year, and it's looking at it by whether, what did the political landscape look like? Was it all Republican? Was it all Democrat? Or was it a divided government? Meaning, we had a Democrat in office and the House was controlled by the Republicans or whatever. So I like this chart because it proves what I often say to clients is, don't look at whether it's a Republican or a Democrat getting in. Like there is no data that corroborates that the market or GDP does better under one or the other. It changes from time to time. You could look at this chart and say, okay, over at the top, if we look at GDP, during all Republican, it's averaged 2.8, all Democrat, it's averaged 4%. That's represented 29% of the time. You can say, oh, well, that means GDP does better under Democrats. And then Republicans will say, yeah, but look at the S&P 500. We're not going to get into political discourse today. But the message of this chart, you can see, if you look over time, whether it's Republican, whether it's Democrat, whether it's divided, the numbers have generally looked the same over time. And so again, when we sit down as a team and we talk about, how we're allocating portfolios, we're not having a lot of conversation about, oh, well, it looks like this candidate's going to get in or that candidate's going to get in. There's going to be a lot of noise about that. But this is just a reminder that, what's going on in the political arena shouldn't be driving your investment decisions in general. Okay. Interestingly, the slide that is not shown is if you looked at, for example, the S&P 500 returns under Obama and then under Trump, they were basically identical. So it's just an interesting, that was a separate chart that's not in our presentation. So, okay, that is it for our presentation, other than the part that you've all been waiting for, which are the disclosures of all the different numbers that we were putting in there. So I'll go slow so that you can read it all. And a reminder, this is recorded. It goes on our website. So if you want to reread it at night, you can come back and you can go on our website, pull up the recording. You can hit pause on the screen and just, knock yourself out. Okay, I want to wrap up, but we have committed to, in these sessions, also sharing, other financial planning tips, things to be aware of. So I want to share one more thing before I let you go today. And that is a reminder. Some everyone know what I mean when I say the Tax Cuts and Jobs Act of 2017. You all know all the details behind that, right? Well, short version, you might have heard us say this in our meetings, but in 2017, legislation was enacted, which dramatically changed the tax. It changed the tax brackets. It changed standard deductions. You may or may not remember, there were a number of changes that were fairly dramatic back in 2017. And when that law was written, this is your reminder, when that law was written, it was written to sunset, and the rates go back in 2026. So how many of you know what's going to change in the tax law in 2026? Nobody? Chris. Good job, Chris. All right, so what I am going to do is just highlight some of those for you, because this might impact what you do with your personal finances over the next 2 years. Now, again, keep in mind, this assumes that Congress does nothing, which is a safe assumption, probably. I shouldn't say that. But it assumes that Congress does nothing and the legislation reverts back to the pre-2017 tax law, okay? They could vote to extend it. We don't know that, but under current law, we revert back And so here are the impacts of that. The first one has to do with income tax rates. In general, on average, each bracket in 2017 went down by 3 to 4%. And so in 2026, each bracket will be going back up by 3 or 4%. And everyone's a little bit different, but when those tax changes were enacted, the majority of people were benefiting from those. Okay, there were some gives and some takes, but overall, the majority of people benefited and were paying lower taxes based on it. So, for example, the 12% bracket goes back up to 15, 22 to 25, 24 to 28, et cetera. So you see kind of a little bump in each of those. In addition, the deductions changed dramatically. Does everyone remember how the standard deduction changed? How many of you, well, you don't have to answer this. This is rhetorical. How many of you itemized deductions prior to 2017 and then started taking standard deduction when the tax law? Yeah, I see the heads nodding. Well, that standard deduction is going back. Again, if nothing changes, it's currently for a married couple, it's actually in 2024, it's going to be 29,000 and change. And that's going to revert back. The levels prior to that were 12,700. Guys, that's a significant difference. All right. So income tax rates change, deductions and tax credits. Also, the child tax credit was significantly increased. I don't know if that affects anybody in here, but charitable giving deductions. Previously capped at 50% of income, that was moved to 60%. That's going back. So that's another change. And then lastly, the estate and gift tax exemptions. Now, this only applies to, federal estates or gifting above a certain level. So maybe this doesn't apply to you. It's a smaller percentage of the population, but currently in 2024, a married couple, 27.22 million is the estate tax exemption. In 2017, that was 10.98 million for a married couple, or 5 something for an individual. So if your estate is, in kind of that ballpark, that there might be some estate planning that you have to think about as well. Okay. So what do you do about this? Number one, our goal was to make you aware or to remind you. But what do you do about it? Well, if you know the tax rates are going up, if deductions are coming down, then you can either accelerate income, like recognize more income now while tax rates are lower, or take advantage of deductions today that you won't be able to take as much advantage of later. So looking at things like, well, should I be making conversions to a Roth IRA? Like pay some tax now so that I can get it in a Roth IRA and not have to pay tax on it later. I would say, our kind of mindset around here is, while your CPA largely their job is to say, how do I minimize your tax bill today? Sometimes we choose to have clients, or we choose to encourage clients to pay taxes today. They don't have to, because it's likely less than they're going to pay in the future. Okay, so maybe converting some money to Roth IRAs, maybe, with the charitable deductions changing, maybe looking at doing more of your charitable giving now, even if you're putting it into like a donor advised fund for giving, later. Those are some things you need to think about. And lastly, again, if you're, if it's possible, you're going to be worried about a federal estate tax issue. Well, now is definitely the time to relook at some of that and make sure that if those exemption amounts come back down, that you're taking action now before that happens. Okay, and we can relook at that with any of you. All right, so just wanted to, again, we like to come in and give an economic update, but there's a lot more that we do to help make sure your finances are in order and you're doing the most with your resources. So just want to keep you posted about that change, and doing it now because you've got 2 years to figure that out. And it's timely because you're probably all going to be going and talking to your tax preparer fairly soon if you haven't already. So it's timely to be thinking about some of that stuff. Okay. That's it for today. I want to just open it up to see if anyone has any other questions they want to share.
Just 2 things that were in the news. Today they were talking about the Josh Shapiro raising the minimum wage. How does that affect the market and everything? Because they have more buying power, but then it could affect jobs as they have higher, the companies have higher costs.
Yeah. I don't have a good answer. I mean, that's one state out of 50. And so, how does that impact? I don't see that being something that impacts the market, but in general, is that kind of what you're asking? Like, how does raising the minimum wage?
Because for some, it gives them more buying power, but then everyone else has to pay more in the long run.
Yeah, so, I always like to think about this from the personal perspective and the corporate perspective. And, sometimes when you think of things from the corporate perspective, it tends to depersonalize and it sounds insensitive, but it's reality, right? So from a corporate perspective, it means higher wages, which means what? Lower profits, right? And so, not every industry is as subject to that because, our team of 9 here, we don't have any minimum wage employees. We don't have those types of positions. But for other industries, it's very heavy in that. And so I would say the impact is more on, okay, what industry is going to be impacted by that? And, would that, suggest a change in allocation? But generally speaking, that's a pretty micro level and wouldn't necessarily drive a significant change in a strategy. Does that help? And you said you had a second one, right?
Yes, so they were saying with a lot of people working from home, office buildings are setting empty, particularly the big
Yeah,
office
yep.
buildings. Will that affect the markets in the long run as more of those loans default?
Yeah, so I would say it affects certain sectors. So like, for example, if you hold a real estate investment trust, right? Something that's investing in commercial real estate. Yeah, I mean, there's some very real concerns in those areas. And, you think of the companies that's their primary business. Yeah, it's definitely having an impact. But again, that's on does that drive like what your portfolio, I don't think in a lot of our portfolios, we have like a specific real estate investment right now. We have in the past, and maybe some of our portfolios do, but it's generally not a large allocation.
So it shouldn't affect it like the housing market did in 2008 with a lot of defaults.
Yeah, I think the organizations that are most exposed are regional banks to those commercial loans. So it's a little more isolated than the housing market of 2008. To James' point, it's more sector specific. So I think regional banks that have high commercial loan exposure could struggle, things like that.
Good questions. You have anything?
Well, regarding on the minimum wage thing, and I don't know if Jeremy or somebody knows better statistics.
Jeremy does.
But I used to own a small business, so I was very sensitive to it. I was against it. But when they enacted this 2 years ago in many other states, you've got 2 main factors. Hardly anybody pays minimum wage, and I bet you there's nobody in Pennsylvania making minimum wage, or it's very, very few people. So, well, it sounds like a huge jump. It really isn't a huge jump. And those states where they did enact a much higher minimum wage, they found it all to be pretty positive. There wasn't a whole lot of negatives. So, while I emotionally was opposed to the whole premise of it, statistically, factually, from what I've read, it hasn't really had any effect.
Well, I think most people are having to pay to get people work now, so it probably doesn't. It's just typically, it goes up for like, but because there's been such a shortage of workers, I think people paying that or more to do it, but it's always something to think about.
Yeah.
Yeah, and the other flip side to that, every penny you're paying those low wage people, every single penny of that goes back into the market. It all goes into commercial spending. The flip side, when the high earners make more money, it doesn't go back in the market. It goes in, they are buying stocks, bonds. I've got a personal example. A company I worked for recently was bought out by a larger company. What did the CEO do of the bought out company? He went and bought a Caribbean island and moved there. So how much of his money came back into the U.S. economy? Very little. So it's not a popular belief in a lot of areas, but just think about the common sense. A low low wage income person gets paid more, it all goes back in the economy, which, as Jamie said, is 67% of our GDP. A high paid person earns more, it doesn't all go back in. So just something to think about.
But how does the consumer respond to the higher prices?
Emotionally, well, and I'm not an
We got some
economist
hammer
either,
here.
but I'm a logical
By the way, this
person,
is
and
our
I try to
presenter
think
for
about
May.
this stuff.
Our next session is-
But think about it, when the hourly worker, McDonald's worker gets paid $2 more an hour, $5 more an hour, and they sell thousands of hamburgers a day. So yes, does McDonald's raise their hamburger price? Absolutely, but they're not raising it $5 an hour. They're raising it quarter, 50 cents. So because of the volume of businesses to compensate the wage worker, we're not seeing a direct correlation in increase in cost from a consumer's point
The
of view.
minimum wage bill is somewhat irrelevant in Pennsylvania because big employers like Walmart, McDonald's, Burger King, they started paying $15 an hour a couple of years ago.
Yeah,
So that forced everybody else to come up to $15 an hour, or people will quit and go work at Walmart and McDonald's. And so, you know, they're codifying something that the market had already driven up, which was wages have already been driven up. You know, it might help 16-year-olds like my daughter who work part-time and probably weren't making $15 an hour as a lifeguard, but by and large, most workers, even at the lower skill levels, are already getting paid that because the market already drove it up. And
It's a good reminder, like, again, the way I would address your question is it depends on the sector. Like some sectors are more impacted by it. And another example, you asked, how does that affect the consumer spending? Well, you know, there are certain sectors of the market that are considered more defensive or recession proof. And I'll use just a very simple example. When interest rates go up, or when when your budget feels a little tighter, you don't stop spending on utilities, as a simple example, right? Like, yeah, you might turn the heat down a little bit, but that's not impacting too much. And so there are certain sectors that are, more sensitive to changes like that. And then there's others that aren't.
These fast food places are not having the customers they used to have.
Mhm.
I mean, I see it all.
Yeah, I agree with you.
in parking
Yep,
lots and-
Yep.
And just going by, there's 4 people in the restaurant.
Yep.
That's why I asked the question.
Yeah, I always feel like, I'm like, I talk about these economic updates, but in terms of like, when I'm in a meeting giving advice, I don't spend a lot of time on economics and politics. Because at the end of the day, like, this is stuff that we want to be aware of. But in terms of actually driving investment decisions, there are so many variables at play and unintended consequences that you're not anticipating, or things that, I'll use this as a silly example, but again, going back to the COVID pandemic and how well the market did. And, there's always companies like what's going on in the world. There's always companies that will be hurt by that. And there are companies that will benefit by it. Right. So I'm looking back at the breakfast and I see a little bottle of hand sanitizer. How do you think those companies did during COVID? You know what I mean? So it's just, there's so many variables in so many different sectors. So it's, again, it just underscores why we invest in the breadth of investments that we do, because we know, like, hey, there's going to be winners and losers in every market, no matter what's going on in the world, whether it's something as small as, a wage change in Pennsylvania to something as large as a pandemic or a war, so. Well, I don't want to keep you guys any longer. We've gone plenty of time, but you asked good questions. Thanks for your time. And obviously we'll be around if you have others.
Thank you.